Let's have a look at shareholders' equity and in particular shares and what that means. There are two subcomponents of shareholders' equity, two specific ones, contributed capital and retained earnings. And contributed capital is really the investment by the shareholders into the corporation. It's usually in the form of shares that have been issued and the cash that the company has received upon issuing those shares. So that's the journal entry that we'll see to record these shares is basically how much cash did we get when we issued the shares to the shareholders. And the second component is retained earnings. And this is really the profit of the company that's been earned over time, and it could be multiple years, decades, it can be a year, it can be all sorts of things. But it's the profits of the company that haven't been paid out to the shareholders yet. And if for whatever reason we've actually paid out more to the shareholders than what we've got for profits, then that sort of overdraft of the retained earnings is called a deficit. Now, common shareholders are one of the classes of shares that we will see. And so shareholders have rights. They have the rights that come along with the ownership of the shares. They have the right to sell the shares. They have the right to vote at shareholders' meetings if those shares have, in fact, got voting rights. They have the right to receive a proportionate share of any dividends. So if we're paying $100 worth of dividends in this class, and there's 100 shares, then everybody's going to get $1 in dividends. They also have the right to the proportionate share of assets if you wind up the company. So if you pay out all the debts or turn all the assets into cash, pay out all the debts, and we've just got some common shareholders left over and we've got $10,000, well, we share the $10,000 amongst all of the shares that are issued. And usually shareholders also have the opportunity to keep their percentage ownership in the company the same. So if a common shareholder has 10% of a company and the company wants to issue more shares, well, that shareholder has the opportunity to buy 10% of the new shares. Now, when we issue shares, there's a maximum number of shares that we can issue, and that's called the authorized shares. Well, that could be, who knows, it could be 10 million, 100 million, who knows, it could be all sorts of it'll be a specific maximum number of shares that are authorized. But the actual number of shares that are issued is called issued shares. So even though we could have $10 million of authorized shares, maybe we've only issued 1 million shares. So it would be, there's two distinctions there in terms of authorized versus issued. When we initially offer shares to the public or perform something called an IPO, there are usually a whole bunch of shares in there, usually thousands or millions of shares that we're issuing. And there are substantial costs to doing that, including underwriter fees and commissions, all sorts of things. And we'll look at that a little bit later. And there are lots of government regulations around this. My goodness, the government wants to make sure that all the information that the investors receive is up to speed. They want to make sure that any information like financial statements are included in those initial public offering documents. Now, again, we talked about there's two different types of shares. The first type is called common shares, and they are the most basic form of share capital. In public companies, again, there can be millions of shares. In private companies, probably less than 1,000 shares. In contrast, public companies, again, are listed on stock exchanges. Private companies can be held by just a few people. All common shares have risk associated with them. Risk being that you're going to put money into buying these shares, but you don't know if you're going to get your money back, or you don't know if you're going to get some dividends. You don't know if you'll be able to sell them for a higher price down the road. There's no guarantees with any of these. They can go up and down in value. Now, sometimes investing in them is a really good idea. If you would have picked Tesla shares at the beginning of 2020 and put $100 in there, Well, by the end of 2020, that $100 worth of shares was worth $731. So that's a good investment. But you can invest in other things like maybe a restaurant. And how many of restaurants have we seen close? So all of a sudden, maybe your shares are worth nothing. There's risk associated with them, and they'll go up and down in value all the time. There's also something called par value shares, no par value shares or stated value shares. No par value shares just means they can be issued for any price. Stated value shares, they're issued for a specific price. And then just like with partnerships, we can exchange shares for assets. And when we do that, we always do it at market value. And that includes the market value of the shares and the market value of the assets. So the second type of shares are called preferred shares. And they have less risk than common shares because they get paid out on liquidation before the common shareholders. So we'll see those shareholders standing in front of common shareholders with their hands out if we shut down a company. They have less opportunity, though, to win big. In other words, if things go really, really well, common shareholders usually do really, really well. But preferred shareholders, they have limited rights and rewards, so they don't get that great big windfall if that happens. They may or may not vote at shareholders' meetings. It all depends on the particular type of preferred shares. And they'll often receive a fixed dividend every year or every month or something like that. And the fixed dividend is usually a percentage of the issued price of the preferred shares. So a 7% preferred share that was issued for $100 means that we'll get a $7 dividend every year. That's the beauty of that preferred share. Now, investors look at preferred shares as a relatively stable income stream, meaning they think they're going to get their stated dividend every year. They know there's a little more risk there, but it's not as much as what the common shareholders are. They're bought and sold. Those preferred shares are bought and sold on stock exchanges, and the market price goes up and down. But again, usually not as big a swing as with the common shares. They can have a convertible feature, which just means that they can convert into common shares if certain conditions exist. The text used an example where we can exchange our preferred shares, say one preferred share, and you get 7 common shares. But even within the preferred shares themselves, there can be different classes, again, different percentages of dividends, certain different voting rights, all sorts of things, convertible, not convertible, all sorts of different characteristics in different preferred shares. And that's our first look at shares.